started and we'll allow the others to join in. Welcome everyone. I'm Kate DiLorenzo, General Manager at Serendipity Labs in Stamford, Connecticut. Along with my colleague Chelsea, our Operations Coordinator, we'd like to thank you all for joining us to today's seminar. How the changing structure of the U.S. venture capital market raises the bar for startup funding, hosted by Brenda Lewis. Brenda is the owner of Transactions Marketing, Inc., a 39-year-old venture management firm focused on the launch and funding of enterprise mission-critical software systems and services. In this seminar tonight, Brenda will discuss the challenges startups face in funding and regulatory changes needed to level the playing field. For those of you not familiar with Serendipity Labs, we are an upscale hospitality-focused workplace solution. We have over 40 locations nationwide, including Stamford, Connecticut, which opened in 2016. Whether you need an occasional workplace for yourself or a more long-term office solution for your team, we offer a variety of membership options that can be customized for your requirements and budgets. We are available to host any offsite meetings and events in our conference rooms and ideation studio. One thing that's unique to Serendipity Labs is the professional networking and valuable business connections that happen organically among our members. So inspired by these connections, we created Link, which is a virtual platform where our members can learn, inspire, network, and collaborate. We invite you to visit Link, and also please reach out if you have any content that you would like to share yourself. I'll now welcome Chelsea to share some Link housekeeping notes for this call.
Thank you, Kate. So before we get started, I just want to remind the attendees that you are on mute for the duration of this presentation. Please utilize the Q&A button at the bottom of your screen to type in any questions you may have for Brenda. Kate and I will be reading the questions aloud at the end of the presentation for Brenda to respond. So without any further ado, Brenda, we would like to hand it over to you.
There we go. Come on, guys. Here we go with the slideshow from the beginning. Thanks very much for that nice introduction, and welcome everybody at 5 p.m. to hopefully your last Zoom meeting of the day. I want to blast through this material pretty fast to allow 15 minutes at the end for questions, because a lot of this, I think, is not in the public, it's in the public domain, but it is not sort of percolated down to startups. And that is why we decided this would be a good third episode for what we hope will be monthly presentations relating to new ventures, and particularly to early stage startups. So let me, from the very beginning, dispel the idea that venture capital was invented in Silicon Valley. That seems to be the prevailing understanding, and that is just not right. If you go back all the way to the 1600s, the Dutch and the Brits created the East India companies competing, and they would club together as wealthy merchants or aristocratic fortunes, ships that they would send out halfway around the world to the Spice Islands for 3, 4, 5-year voyages. And when they would come back, divvy up the riches. In the United States, I personally believe that the first venture group was in New England with the cod trading operations. We're not talking here about sustenance fishing for the Boston market or the Baltimore market or whatever. We're talking about the folks who traded with Portugal and Spain. So they had dedicated transatlantic ships and revenues, and those revenues really enabled the colonies to split off from Britain, which with every other colony required the carriage of goods back and forth only in British flagged ships. If you have not read Cod, A Biography of the Fish That Changed the World, I certainly commend it to you. It'll change your idea about the American Revolution. In the 1850s, we had the beginnings of what I think the real antecedents of venture capital in this country are beyond cod trading. The New England whalers, 900 ships strong in 1853, absolutely dominated the global whaling business. And you know the ports, New Bedford, Salem, Greenport, but of course the biggest one was Nantucket. And they were Quakers. And what they did was group together and share their investments in these whaling ships. And they, unlike today's billionaires that are being minted in Silicon Valley, did not spend their money on mega mansions and jewelry. They invested in other businesses, and in fact, their fortunes financed the Industrial Revolution in New England, in Pawtucket, Rhode Island, and later in Lowell, Massachusetts. So they actually have provided some nomenclature, which we're going to touch on at a little farther on in the presentation. Another building block was in the 1870s. We had the New York merchant bankers co-investing with large European capitalists to finance railroads and steel as the Industrial Revolution moved west. And then in the 1890s, we had what we call the robber barons, pre-income tax fortunes, family foundations, most of these generated in the oil business. And they provided another building block. They hired professional managers to source opportunities, evaluate risk, and negotiate deals on behalf of these family enterprises. Some of them actually exist today. I mean, Venrock is a Rockefeller-backed venture capital firm, and I remember when I started my business in 1981 calling on them. Bessemer is another one that exists today out of the Phipps fortune, and of course J.H. Whitney is a leading PE, private equity company. The real beginnings of tech investment in ventures was funded by the US government. It was World War II and the Cold War. We, unlike the Germans, had no US research labs. There was no JPL or Battelle or Lawrence Livermore at the beginning of World War II. And the president appointed Vannevar Bush to oversee R&D grants to the big East Coast universities, and MIT, Harvard, and Columbia. And out of that came radar, microwaves, computers, and of course, the bomb. Then along in 1957, you had Sputnik, and it was obvious the Russians were ahead of us in space, and there was a big thrust, which I'll touch on in a minute, of money that was going to be invested again in R&D for technology. But up until this point, there was absolutely no venture capital in what was the Santa Clara Valley, and no finance that was not military sponsored. The first venture capital firm actually in this country was on the East Coast in Cambridge. It was George Doriot, the so-called father of venture capital, American Research and Development Corporation, 1946. He was a Harvard Business School professor, a distinguished general in the war. And his famous investment was 1957, $70K in equity and $2 million in loans in DEC. And by the time the fund closed, and it did close down and didn't remain as a venture capital firm, they had a 5,000% return. So again, 1957, the key year, Sputnik, a man named Frederick Terman, who had been an MIT student of Vannevar Bush, was now the provost of Stanford University. And working with Vannevar Bush, he directed funding to Stanford University for the research there. And that is what really kickstarted tech ventures in Silicon Valley. The most famous of them, of course, Fairchild Semiconductor. And if you haven't read it, there's a wonderful book by Tom Nicholas called VC and American History. And it tells you all about the traitorous eight and the beginnings of tech in the Valley. The key thing to remember, though, is that zero finance on the West Coast. Crocker and Wells Fargo were consumer, that is retail banks. So that deal was negotiated by Arthur Rock, who was a New York City investment banker. And out of that effort grew some of the models for venture capital that we use today. Arthur Rock was the people model, invest in the people. They're the jockey, not the horse. And of course, his track record is absolutely brilliant in the business, not just Fairchild, but Intel, Teledyne, Apple. The technology model was really Tom Perkins. He plucked Eugene Kleiner, who was one of the traitorous 8 out of Fairchild, and formed Kleiner Perkins in '72. And the person who uses the market model, sort of beginning of the market model, was Don Valentine at Sequoia, also in 1972 founding. As far as finance, again, the big banks were doing nothing. So enter the 4 horsemen. These were boutique investment banks. They did almost every IPO between 1970 and the dot-com bust. And these were the guys I worked with when I was first in the business. So here's what it looked like from the beginnings until 2008. And it's 2008 for a reason, of course, the global financial meltdown. Take a look, 2 bars from the left, that's 1980. That's when I started in business. There was $4 billion in venture capital at that time. And of course, it's invested over time. So that was about $500 million that was being invested in the year that I entered the business. Then you see these 2 big bars in the middle. That's year 2000, year 2001. Of course, that's the dot-com bust. Anyone and their brother could get money thrown at them, including the chauffeur for the CEO of AT&T. And that was stupidness, just complete, fluff. Think pets.com and Webvan and all those not profitable companies. It took a long time for the excesses of that period to burn off. There was about 60 billion of capital that was an overhang, and venture capital companies who had raised it were trying hard to sustain those companies that they felt could win. And a lot of people were just let go, dropped in terms of new ventures. And you can see that big swoop, that was all decline, flat. What really brought it back at about 30 billion of investment in 2007 was the launch of the Apple iPhone. Now, as you know, venture capital is risky. 2 in 10 investments make returns. The rest go bust and or return, nothing to capital. In tech, that number is about 90%, so 1 in 10. To get those blockbuster returns like digital did with ARD, you have to diversify your bets. So you have many investments, and you try and invest at seed stage and then allow enough what we call follow-on capital so that you can invest and retain your share in the venture in a Series A and a Series B and hopefully an IPO. Unfortunately, it doesn't always work that way. And the Kauffman Foundation, which is the leading entrepreneurship research foundation in the world, based in Kansas City, did a study in 2012 which showed the emperor had no clothes, that in the 20 years preceding, only about 10 VC firms of roughly 1,200 were profitable, and the rest barely broke even. So just a quick reminder on the structure of venture capital before we dive into some of the impacts and changes. The red block there is the venture capital firm, the general partner. So think Sequoia, Kleiner, Draper Fisher Jurvetson, Lightspeed, NEA, Andreessen Horowitz. They go out and solicit fund contributors, limited partners. And those people are public and corporate pension funds, insurance companies, high net worth individuals, family offices, university endowments, foundations, sovereign wealth funds. Once those folks have committed money to the venture capital fund, which is a limited partnership, this is the blue box, they are passive. They have no role to play. The general partner manages the fund and makes the investment. The investments are the ventures. Those are the black boxes down at the bottom. So how do VCs make money? There are two ways. Management fees, 1 to 2% annually of committed capital. So let's say you have $1 billion venture fund. That means you make $20 million a year at 2% for the life of the fund, which could be as long as 10 years, whether or not the fund is profitable. That, of course, is taxed as income at 37%. Carried interest. Remember I told you we brought nomenclature forward from those shipping ventures. The practice of ship owners and captains to get a percent commission of the value of cargo carried, usually about 8 to 12%. So in one of those whaling voyages, let's say they made $150K, a ton of money, obviously, in the 1850s on whale oil or after expenses. The captain might get 10%, the first mate 7%, the surgeon and the carpenter and the cook maybe 3%, and the crew would get 1%. Fabulous riches. But nearly a third of those whalers never returned. So carried interest is the reward for risk capital. And the venture capital firm today gets typically 20% carried interest on a fund that's roughly 10 years long. The general partner, the red block, remember on our little chart, that's the firm, typically invests maybe 1 to 2% of their own money in the fund. So, whoops, sorry about that, guys. What have I got here? Advancing my slides. This is what has changed the game. This is a chart of the 10-year US Treasury bond rate from the 60s up until today, 2020. And you will note that back in the 60s, we're talking about 4% rate of return on a 10-year bond. And remember, the 10-year US Treasury bond is the benchmark for mortgage rates in the United States. It is also the most widely held and widely traded bond in the world. Today, well, I'm going to hold off on today because I want to tell you, here's the 4% back in the 60s. You had horrible inflation. Volcker came on in 1980 and drove that 15% rate down sharply as he drove inflation out of the US economy. And then you had a return gradually down to 2008. We were back to about a 5% return on this long-term US Treasury bond. Then came the money center banks in 2008. Selfish, greedy, white males without understanding, too stupid to understand counterparty risk, destroyed the global economy. Look at where the rate went, down to 2% in 2009. Now it came back, but now it's been with quantitative easing, which is the Federal Reserve's effort to juice the economy. It has today reached under 1%. This morning, the 10-year Treasury bond return was 0.91%. Now think about the people who have to invest in these long-term obligations. Pension funds, university endowments, municipalities with capital investments, whether it's schools or roads or bridges. This is the underpinnings of long-term capital investment around the world, not just in the United States. So there are a lot of people hurting as a result of this tremendous slide from basically 5% in 2008 down to less than 1% today. A second issue is that in 2009, our senator, I'm sad to say, Chris Dodd, who was the chairman of the Senate Finance Committee at the time, presided over the formation of the Dodd-Frank bill, which allowed a capital gains rate treatment for hedge funds and private equity investment after only 1 year holding period. 1 year. Now that's been bumped up to 3. But meanwhile, these guys had 8 years of huge profit tax protected at 20% versus 37%, creating huge inequality in the United States and a total windfall for them. And let's compare those with venture capital firms. Their carried interest at 20% is a 10-year holding period. They are assuming real risk. These guys with the 3-year venture aren't assuming a lot of risk. So what has been the impact on venture funds of these two developments? One, the collapse of long-term returns on the 10-year treasury, the benchmark bond, and the tax treatment of carried interest for PEs and hedge funds. Well, here's what we've got. In the first half of this year, private equity, hedge funds, and sovereign wealth funds accounted for 82% of all late stage, that is pre-IPO venture investment in the United States. 800 VC transactions, driving the late stage venture rounds to an average of $60 million, which is an all-time high. And according to Pitchbook, which works with the National Venture Capital Association, the deal size went from 2009, 12 million for a late stage deal. That's now 36 million. 2009 average VC fund size was 122 million. The first quarter of this year, 344 million. So huge impact on venture funds of these changes. And here's what it looks like in blazing color. Take a look at the purple bars. On the one side, the left-hand side, you've got the total number of US funds. On the right side are funds under management in venture capital. The purple is funds over $500 million. And that means there are billion-dollar funds, but these are over 500 million. In the years since 2008, we have seen these balloon to represent 2/3 of all assets under management in venture capital in the United States. Now take a look at the left graph. That is the total number of funds. See those blue ones? Those are funds that are between $0 and $25 million. Remember, the average fund before 2008 was $122 million. Today, these little 0 to 25 million funds, these are called micro funds. And if you'll note, there aren't a whole lot of assets under management that are blue on the right-hand chart. So what has this done? It's forced VC funds to raise bigger and bigger funds so that their stake in the risky part of the market, in the seed rounds and the A rounds and the B rounds, is not diluted by these late stage non-traditional investors. Well, another aspect of the non-traditional investment is pretty clear to most of you who follow this, and that's unicorns. For those of you who don't know that, the definition of a unicorn is any company that has reached a $1 billion valuation and is not yet public. It's still late stage, pre-IPO. And as you can see, although this chart ends at 2018, there are over 160 unicorns now. I mean, this trend is just going one way, and that's up and to the right. And these unicorns may not be profitable, may not have revenues, and may not have a sustainable business model. One just went public called Palantir that had no revenues and no profits. It had revenues, it had revenues, but no profits. So, this is another way of looking at it. Dry powder. When a venture fund is raised up, you don't, as I mentioned, invest it all at once. You make a lot of seed round investments and some Series A investments, but your idea is you get a nice seed round and now you're going to have follow-on money to invest in a Series A or a Series B, and eventually they hopefully go public or get acquired. In 2019, in the middle of the year, this is the last number I could find, the Pitchbook estimated that there were $121 billion in dry powder, meaning funds that could be invested in follow-on rounds in the venture capital community in aggregate in the United States. However, the same number of dry powder for US non-traditional funds, hedge funds, PEs, not sovereign wealth funds, family offices, CVCs, $250 to $340 billion. So you can see that huge impact that tsunami of cash has made on the venture funds. And how has that played out for new ventures in the late stage? This big, flood of cash. First of all, firms stay private longer. They raise larger late rounds. And those valuations, as I pointed out, are driving into the sky, whether they're profitable, whether they have revenues, whether they have sustainable business models. Think WeWork as an example of, how not to do it. These are called growth equity rounds. And again, this is very close to the traditional private equity model, but not the venture capital model of traditional, that pre-2008. Another important impact on new ventures, the more rounds you have, they reduce founders' equity. Many of these companies are going public and the founders do not have anything close to 50%. Also, late rounds carry guarantees. So let's say you have Series E, F, and G, way beyond the traditional A and B. Investors, let's say I'm a private equity investor in the last round, an H round in your new venture. I put in $13 a share equivalent in my round, but you go public at $10 a share. Hello, I have a guarantee. You owe me more shares. Take a look at Square's IPO, written up on the web, the poster child for this kind of late round guarantee. Finally, another way in which companies, new ventures are impacted, are in this late stage, a flood of money. You have a delay in exits. So the velocity of cash turning reinvestment in new ventures is slowed down. And it's exactly what you would expect. The extent of this late stage financing has depressed seed investment. In COVID, now this is obviously a little of an aberration, but Pitchbook is estimating a 25 to 30% decline in seed investment this year, in 2020, based on the last 3 quarters. And you can see that has been in train for quite a while. These blue bars represent follow-on financing. That is Series A, B, C, etc. If you look at 2020, there's been 141 million of essentially all financing, both first financing, which is basically the seed round. There's a little Series A in there, but it's mostly seed rounds. That's the dark blue at the bottom. And then the light blue, that's the rest. So of the 141 million through September 30th of this year in the United States, only about, I think it's about 4 billion of it has been in seed stage. So 4 billion out of 141, we're just under 3% in seed rounds. Now, in addition, we have another problem that has stemmed from this tsunami of cash in late stage, and that is early stage companies are now required to have revenues. If you look here in 2010, this number, 17%, is for Series A funded companies. I'm sorry, I'm getting ahead of myself here. 17% in Series A. The equivalent for seed round, which is what the first stage of venture investment is, was 9%. Only 9% of all seed funded companies in 2010 had revenues, so 90% did not. Flash forward to 2019, 77% of all Series A funded companies had revenues, and 67% of all seed rounds had revenues. So, if you're thinking you're going to raise venture capital in the next couple of years, excuse me, you're going to have revenues. Here are some things that you can do to deal with the impact of these trends. First of all, before you write a line of code, do a good business plan, a teaser, an investor deck. Even if all you're doing is pitching to your friends and family. You need a competitive frame. You need a risk assessment. You need demand research. And if you think you have any kind of intellectual property, go see an attorney right away. Get a provisional patent if you can. The second thing you can do is keep funding your company with personal funds as long as you can. That's called skin in the game. You want to, maybe get a loan from your friends and family. Get a loan on your home if you own one. Home equity loans right now are dirt cheap because interest rates are in the sewer. Use state and school grants. You may be part of an alumni association. Yale has $100,000 fellowships. UConn has the Husky Fund. And Connecticut Next has some $10,000 grants. Take advantage of those. Every little bit helps because it doesn't take away from your equity. If you are in an incubator or an accelerator, try to get one that doesn't take equity. Texel Stanford, which we run, does not take equity. I personally think it's like stealing candy from a baby to take 6% equity from a company that doesn't even understand valuation. But let's say you're lucky enough to get into Y Combinator. They have a seed fund. So if you do that, maybe the 6% is worth it. You got to check that one out carefully. If you have intellectual property, consider applying for an SBIR grant. That's the Small Business Investment Research Grant. These are administered by the Small Business Administration. It's a federal agency. Things like the Department of Energy, the National Institutes of Health, NASA, the Department of Defense, all of these guys post research programs, things they're interested in funding, and you can apply. Maybe you can get a grant. The first tier of such a grant is worth $150,000. But the main thing that you're going to have to do is to focus on sales. As we saw from that prior chart, now I've done it wrong way. These are ventures. As I said, we are focused on that venture funding. That is a real challenge for you, and you're going to have to try and get revenues as soon as you can, because there is absolutely no question that you are going to have funding if you're going to go for seed round in the next couple of years. Finally, if you have a consumer product, do consider equity crowdfunding. It's well established now. There's some excellent companies out there. This is where you have a product. Let's say you've got the next best automatic mop in the market. You offer your mop as a beta product to your investors at X, that's your share price, and you can raise money that way. I do not recommend this for B2B. I'm happy to go into the reasons for that in the Q&A, but I do think it is something that any company that has a good consumer product should think about. So I'm going to stop now and entertain any questions that you may have. I expect, I've covered a lot of ground here, and some of it may or may not be familiar to you. So I want to take the time to address those questions. Chelsea?
Thank you so much, Brenda. We really appreciate all your knowledge and taking the time to really spend it delving deep into venture capitalists. And
Can you turn your mic up just a bit? I'm having trouble hearing you guys.
excuse me, can you hear me now?
Yeah, thank you.
Yeah, we just want to say thank you. We do have one question ready for you. So this one came in anonymously. It's, what's the best way to attract venture capitalists given the change in the market due to COVID-19, in your opinion?
Well, I'll state my my prejudice, obviously. My company has two pieces. One, we work with companies in formation to help them with those early documents and prepare them to raise money. But for companies that are already entering the market, in other words, they're ready to go for funding, we do funding facilitation for seed and Series A rounds. So I certainly would suggest in this particular environment that you use somebody who knows the ropes. I mean, we happen to have a network of 250 investors because we've been in business for 39 years. Not everybody is that lucky, but I would certainly not try and go it alone. One of the things that Pitchbook has said in a lot of the documents that I've researched here is that people who are entering the market for the first time, that is the first sequence of funding with venture capitalists, are having a lot more trouble getting funded. And that makes complete sense because it's all virtual today. And this is a people game. They want to kick the tires. They want to see how you and your team operate, you know, what the chemistry is and so forth. So if you're going for capital for the first time, use a facilitator, get referrals, don't try and go into it cold.
Brenda, kind of on the heels of that, I have a question in regards to your experience or your suggestions to, you know, getting legal support around this. I can imagine it's a very daunting experience for some that are not familiar with raising venture capital. Is there that that kind of way to really kind of get a legal support around you and protect you?
Yeah, that's a good question. We recommend to people who are raising money, even first rounds, even if you're just doing friends and family, you really need a document. Yeah. And you should have a lawyer who knows the ropes. And we can certainly recommend some. We work with people all the time in those areas. There is no question that this can be very daunting, and you do not even, you can go and look on the National Venture Capital site. They have some wonderful templates for various types of investment documents, and I certainly would encourage people to do that because those are, I happen to know some of the experts who put them together. They're wonderful, but in the end, you really want to have a legal eagle on your side. And most of the companies that work with young ventures have pretty reasonable rates. They have ways of helping you extend your legal fees so that they're not crushing for your cash flow. The other thing is, once you get to the point of an angel round, and you know, as I say, a document is good even if you're doing a friends and family round. If you're doing an angel round, you need a transactions lawyer to help you with a term sheet. You want to go in as prepared with a term sheet as they, on the other side, the VC or the angel, is going to be prepared with a term sheet. Don't just accept theirs. You want to go in knowing what your pre-money valuation is, or at least have an idea of it. And we in Texel's Accelerator, we have venture experts. In fact, we've just finished with the term sheet and capital table and valuation section, but we make sure that our people know what those are and have resources to tap before they go out and not go alone.
And what was that site that you mentioned, or that resource that you can find?
NVCA, National Venture Capital Association.org. That is a wonderful resource. In fact, if you're interested in any of the sort of nits and grits of some of the research I've used here, they have a thing called the Venture Monitor, which they publish every quarter, and you can get all the grim, up-to-date statistics about seed rounds and the collapse of seed funding that they expect and so forth. But they also have wonderful research resources in terms of these documents.
That's great. Thank you.
We actually have another question for you, Brenda, also anonymously. This one is, how much more successful are companies that receive venture funding versus those that don't?
That's a really interesting question. It depends on what kind of a company you are. For example, the vast majority of companies that are founded in the United States are Main Street businesses. They don't have venture capital at all. Under 5% of all companies are venture funded. The vast majority are family and friends, a loan from a local bank, because they're serving their community. They are maybe a new mechanics shop, or a plumber, or a pizza oven, or a gift shop, catering business. Those are all community-based businesses, and they represent the vast majority of businesses formed in the United States. We are not talking about that kind of business in terms of venture capital. Those types of businesses do not qualify for venture capital. Typically, a venture capitalist will not invest in a market that is not going to be bigger than less than $1 billion a year in revenues. On an annualized basis, your market needs to be probably $1 billion or more to even get a venture capitalist to look at you.
Wow.
Does that answer your question? I hope.
I think you definitely explain the difference between what we're talking about and what venture capitalists are looking for. Of course, there's millions and millions of companies out there, and the smaller ones, as you mentioned, you know.
Yeah. And again, you know, a sort of corollary to that, of that 5% that do go on to apply for venture capital, there is a huge failure rate. I don't need to tell you that. I mean, that's out there in the public domain. 90% do not survive after, I think it's 2 years. A lot of them tank before they ever raise $1 million. And the reasons for that, I think, you know, go back to my earlier seminar on leadership, and that is 50%, they've absolutely misunderstood the market, maybe haven't done demand research. There's another whole cadre that fail because their leadership team is not appropriate. And then there are some that haven't done their competition research and they get hammered. You know, a lot of reasons for failure, but the big one is the failure to understand your market.
Right. And you have a lot of experience with venture capital and I guess those kind of like Shark Tank presentations.
Oh, please don't tell me about Shark Tank. That is not the way it works.
Yeah. So you've seen a lot of that, and yeah, have some good insight into what the venture capitals are looking for. And I think it's a great connection back to your first link event with us, which if anybody's interested in seeing, we'll send out the link so that you can get a history of Brenda's relationship with Serendipity Labs and Link.
Just don't forget, the first one I had the camera on the wrong way. So
no, it was great. It's great.
It was an excellent presentation. It really was.
And I didn't know that I had to make sure that the slides didn't overlap with the Zoom pictures.
It was wonderful. We're learning each Link event that we have with you, Brenda, and we continue to thank you for your knowledge and guidance through these really interesting topics. I know that more will be coming up. And a message to the group that we will be sending out some information on how to connect directly with Brenda and a way to redeem a complimentary day pass at Serendipity Labs. So I'll give one more moment for anybody that wants to ask a question. They can raise their hand and you can come off mute, or you can type your question in the Q&A box below your screen. We'll see if anybody else has any questions. All right.
Is it Miller time yet?
Right, that's right. Well, you know what? I also want to thank some of our attendees. We are noticing that a few of our attendees are actually from other markets that Serendipity Labs is in. So they are connected with other locations while we're hosting and based here in Stamford, Connecticut. It's great to have these events where we can bring in the rest of the nation and not have to think so localized with these events. So thank you for those that joined us from other locations. I really appreciate that. And we'll be having more coming up soon, and you'll be able to visit our website to see more invitations to our link events, including Brenda's continued interest with us.
Okay, everybody, stay safe, be well.
Yes, thank you again, Brenda.
Thank you so much.
You're welcome.
Everyone.
Bye-bye all.
Bye.